Thank you for master. We didn't win, but the judges gave us good feedback that we had a good pitch, and it sounded logical.
Good.
Can I actually bother you about race?
Yep.
Are you around tomorrow? Like
Tomorrow I should be around. Friday I won't be.
I will bother you about race.
Okay.
Exciting stuff.
Okay. Walk around, put this on and just walk around. That's why I show up like 7 minutes early, because it takes like 3 minutes for it spinning around. Usually it's going to respond back badly, it respond back right away. And the computer had been turned off, so it's got to go through security checks like crazy. Worst case scenario, I've done sessions without the slides, so no, but I remember what's on the slides too, so it's not as if it's going to be complete loss. So we actually had one day when everything failed. The projector failed, and the projector used to fail fairly frequently. That's why they have two projectors now. If you look up there, they have a backup projector, because the projector used to fail all the time. PowerPoint will take another 2 minutes to open. Okay, you scroll it.
Greetings, classmates. I just wanted to let the Energy Club make an announcement on behalf of the Energy Club. We're hosting a project finance seminar on Sunday, March 8th at 1 p.m. It will go until 4 p.m. We have Professors Godet and Wachsberger, Godet from Stern, of course, and Wachsberger from the law school leading the seminar. It'll be an overview of the financing mechanisms for big projects like power generation facilities, bridges, stadiums, and then we'll also walk through a sample model, and you'll get to see that model in advance and take it home with you if you find yourself in the position of working on some of these big projects in your future roles. So I hope you'll come out. You can register on campus groups. It's $15 for non-Energy Club members and $5 for Energy Club members. So if you're interested in government or big projects, construction, energy, please come out. Thank you.
While I'm waiting for PowerPoint to load, it seems to take forever. A couple of quick announcements. One is, I don't know whether any of you signed up for the TA sessions, but the TAs run weekly sessions. I think it's Wednesday at 4:30. So there's a Google spreadsheet. You're saying, and these are kind of, they basically what they do is they take problems out of the old quizzes from that week and work them through. And you're saying, review for what? I have some bad news. This is session 7 of the class, right? Which means you're more than 25%, after today's class, more than 25% done with the class, which also means that the first quiz is not that far away. It's a week from Wednesday, okay? No need to freak out. You still have time, but if you haven't even thought about it yet, maybe it should start to show up somewhere in the horizon, somewhere in there, right? The second thing is today is the last day to sign up for S&P Capital IQ. Okay? If you have no idea again what I'm talking about, you better find out what it is, because tomorrow or day after, a week from now, you're going to go looking for data, and if you have access to Capital IQ, you'll have a lot easier time finding the data than if you don't. So I'll send out that reminder again in case you haven't signed up yet. Okay? So okay. The third is, did I notice that sign about something to do with sports stuff? And is there something going on in the school? There's always something going on. But I thought I saw the name Frank McCourt in there. What is this, part of a series on how to ruin a sports franchise? For those of you Dodger fans, you know that Frank McCourt has no business talking about how to manage a sports franchise. So maybe, if you don't know what I'm talking about, you don't know baseball, go and read the news stories if you want. Maybe a week from now, Brian Cashman will have a session on how to sign a third baseman cheap. Followed, of course, by James Dolan on how to ruin a professional basketball team in 3 easy steps. Topped off by Rex Ryan on how to nurture a young quarterback. All part of a series, I'm sure. Okay? Actually, if this day after tomorrow, I'm supposed to be in Boston, and I think I might, did I mention this? For an MIT sports conference, and I think they're going to carry the session live. It's MIT, they carry everything live, so they're unable to restrain themselves. So if they do put it live, I'll send you, because it's going to be a fun session, because it's about valuing and pricing. It's actually about valuing a sports franchise. Let me ask you a question. Is it difficult to value a sports franchise? Yes. No, it's actually very easy to value a sports franchise. Got you on that one. And here's why. Sports franchises, by their very nature, can make their money. This is a complete tangent, but it's so much fun, might as well talk about it. There are only 3 ways you make money. One is gate receipts. That used to be the only way you made money if you were the Yankees in 1935 or 40. The second is merchandising. What's the third? What's a big part of every sports franchise is an entertainment business now, because you get 60, 70, 80% of your revenues from media. And that comes from either national TV contracts or local TV contracts. And how much money you keep varies depending on the type of sport. So for instance, in the NFL, it's all national TV contract, and every team gets an equal share. So if you're the Washington Redskins, the Green Bay Packers, or the New York Jets, you all get the same share of the national TV contract. So what that effectively means is that if you look at the revenues of the NFL teams, there's not that much difference. The Dallas Cowboys have higher revenues than the least revenue NFL team. That's the NFL. The MLB has the most skewed setup. In the MLB, because TV contracts tend to be local, you get to keep most of your local TV revenues. And you can already see the consequences of that. The Seattle Mariners will never, ever, ever be worth as much as either the Yankees or the Mets. It's unfair because you don't have as big of a media market. Okay? So if you valuing a franchise is easy because you have 3 sets of cash flows. The cash flows are actually pretty set. I mean, you have renegotiation of TV contracts. The NBA, for instance, the big deal is in 2016, the entire TV contract is going to be redone. And because it's become a global business, it's going to be a much, much bigger set of revenues. So I actually have a valuation of the Clippers. And you know why I picked the Clippers, right? I did this when Steve Ballmer decided that he couldn't deal with Microsoft anymore. He preferred to deal, and he bought the Clippers for $2 billion. And valuing the Clippers is not difficult. Here's what's difficult. Pricing a sports franchise is difficult. Whether it's the NFL, MLB, NHL, does anybody even care about that? But you know, you can count that in. It's IPL, soccer. Right? Pricing is difficult because there are probably about 160 professional sports franchises in the world, and there's a celebrity premium. an ego premium, a plaything premium. In fact, my rationale for why Steve Ballmer paid $2 billion for the Clippers is he wanted a play toy. No, seriously, he was willing to pay $800 million so he could play. Played by sitting in the sides, and this is my. You look at how much fun Mark Cuban is having with the Cowboys. With the Mavericks. Why should he have all the fun? I was going to say, well, how much fun Jerry Jones is having with the Cowboys, but that's. I'm not sure he's having that much fun. He looks like he's going to have a heart attack every 15 minutes, right? But I said he's paying $800 million. See, that's a lot of money for a play toy. When you're worth $20 billion, you can spend $800 million for a play toy. Which effectively means that if you're a business person, do not buy a professional sports franchise. Because you're never going to make the money back in terms of cash flows. But you get to be celebrity in that city, you get to invite all the people, you get to be in the front row, you can do. Okay? So there's a pricing premium, and that pricing premium increases over time because the number of crazy celebrities is vastly greater than 160. And that's a problem. So you have people trying to either buy celebrity or buy status. A lot of Russians buy teams. Even, I mean, they might not even care about the sport. It's a way in which that they can get an entree. Look, I'm a billionaire. Listen to me. Look at me. I am special. So it's actually a fascinating pricing process. In fact, there's an article in the New York Times today about a Nobel Prize winner, Simon Kuznets, trying to sell his Nobel Prize, how difficult it is to price a Nobel Prize. It's a strange thing to say, because there aren't that many that get sold. So how do you come up with how much somebody will pay for a Nobel Economics Prize from 1971? The bidding starts at $150,000. If any of you are interested in buying a Nobel Prize to put on your mantelpiece, I'm not sure what you do with it though, because you can't act like you got the Nobel Prize. Unless you got some really stupid guess and say, I got that Nobel Prize in 1971, and they believe you. Okay? I don't know what it buys you, but pricing is a very, very dicey game. And pricing a franchise has nothing to do with projecting cash flows and adjusting for risk. It's projecting who the craziest celebrity will be interested in that franchise and how much of a premium he or she will pay. So if you're interested in sports franchises, and there are, whatever sport you're in, there's a franchise out there that you probably are either a fan of or you hate. Either way, you're interested. I'll put that webcast up when it comes up. So let's get back to corporate finance. Okay. Or let me get to the right slide number here. So we were talking about equity risk premiums on Monday. Any questions on equity risk premiums? Very quickly reviewing then. I came up with equity risk premiums by country by starting with an implied premium for the US. And remember, today is the 25th, which means in 4 days I will put up the update for the equity risk premium in March, and who knows what that number will look like. And then I adjusted that premium for different countries. So this is my page of country risk premiums. And I said the reason you will need this, even if your company is a US company or a German company, is because you get revenues from other countries. Which means that to come up with the equity risk premium for your company, and separate the two, don't make your company the country. So if you're a Brazilian company, doesn't mean that the only country premium you care about is Brazil. Look at the breakdown of revenues for your company. And some of you have already started doing this. The way I know is I'm getting emails about problems you're running into. And some of you haven't picked your company yet, so let this be my guilt prod thing. Wake up, get up a company, start looking for this, because you need that breakdown to get an equity risk premium for your company. So try it out. See if you can get the revenue breakdown. Work with what you have. Companies are not very good about breaking down their revenues geographically. Work with what you have. And if your company happens to have 50% of its revenues in Afghanistan and 50% in Iraq, come and talk to me. I'd really like to know what company this is. Okay? But let's face it, if you have Halliburton, or you could very well be getting a big chunk of your revenues from frontier states. If you really have issues, seriously, come in and talk to me. We'll talk about a pathway in which you can come up with an equity risk premium for your company. So we've got the risk-free rate, I think, nailed down. So you give me a currency, I'll give you a risk-free rate. We've got an equity risk premium for your company. There's one final piece to the puzzle, which is the beta, right? So today's session is about estimating betas. And if you've taken foundations already, which most of you have, and are taking foundations right now, you were probably taught betas the same way I was taught betas, which is to run a regression of returns on the stock against returns on a market index, and we're told that the slope of the line is the beta. It's a terrible way to think about beta because it makes it a statistical number. But that regression is actually a good entree into understanding your company. So what I want to talk about today is if you run a regression of returns on your stock against returns on a market index, and we'll talk about how to structure that regression, what is it that you can get out of that regression that will allow you to understand your company better? In fact, the slope of the line is a rough estimate, and I'll use the word rough to kind of back it up. Rough estimate of your beta. But there are two more pieces from this regression. This is a simple regression, right? Dependent variable, independent variable. Your dependent variable is your stock, the independent variable is the market. Whenever you run a regression, and this has nothing to do with finance, you get a slope, you also get an intercept, right? That's classic. In every regression, you get an intercept. I'm going to argue that the intercept from this regression tells you something about how well or badly your stock performed during the period of the regression. Let me state that again so that you're very clear about what I'm describing. The intercept of the regression tells you how well or badly your stock performed. Keyword is performed. So it's in the past, it's a post-mortem, during the period of your regression. So if you ran a regression for 2 years and I give you the intercept, you should be able to use that intercept to tell me whether your stock was a great stock, an average stock, or a terrible stock during that period. And I will go through the process of why. So you've got an intercept, you've got a slope, you also get an R squared from a regression, right? Tell me again in statistical terms what the R squared of the regression gives me as output. What is it telling me? What's the R squared of any regression telling me? How much of the variation in your dependent variable is explained by independent variable? So this is not a statistics class. Let's make it more specific. What's your dependent variable here? It's the stock. What's your independent variable? The market. So when I say the R squared is 40%, what am I saying? 40% of the variation in the stock is explained by the market. Does that sound mildly familiar? When we talked about deriving risk and return models, remember that key step where we took the risk in a stock and we said, you're not going to get rewarded for all that risk. You're going to get rewarded only for the portion of the risk you cannot diversify away. R squared tells you how much of the risk in your stock you're not going to be able to diversify. And by extension, it also tells you how much of the risk in a stock you're not going to get rewarded for. That's the wasted risk you take on when you don't diversify. So let me first set up this process so I can, and then we'll go past the abstractions. You run a regression, you get an intercept, right? The intercept reflects what your stock actually did over the last 2 years to the last 5 years. So think of the intercept as a measure of what your stock did in a month in which the market did nothing. That's the way basically the intercept can be read. If we go back to the CAPM, that's a model we're working with. The expected return on a stock is the risk-free rate plus beta times RM minus RF. That's the classic equation. I'm going to do a little algebra. I promise you I'm not messing with the equation. I'm just moving terms around. I can rewrite the CAPM as the risk-free rate times 1 minus beta plus beta times RM. So that's the CAPM. There's the regression equation right below it. Compare those two equations. The second term is the same, right? So those terms cancel out. If my stock did exactly as predicted during the period of the regression, the intercept should be roughly equal to the risk-free rate times 1 minus beta. So in other words, I run the regression, I look at the intercept. If my company did about as expected by the CAPM, that intercept should be roughly equal to the risk-free rate times 1 minus beta. If my stock was a winner, it was up 400% over the last 2 years, the intercept is going to be much higher than the risk-free rate times 1 minus beta. And if my stock was a loser, it did much worse than the market, the intercept is going to be much lower than the risk-free rate times 1 minus beta. Here's the way to intuitively put pegs on these two. The risk-free rate times 1 minus beta is what you expect your stock to deliver in a month in which the market does nothing. The intercept is what it actually delivered. So if your stock did better or worse than expected, it's going to show up in the intercept. In fact, if I take the difference between the intercept and the risk-free rate times 1 minus beta, I get what's called Jensen's alpha. You're saying, who the heck is Jensen and why is he calling it an alpha? Alpha basically comes from the fact that it comes from a regression. The intercept classically in a regression is called the alpha. Jensen was Michael Jensen, who's one of the fathers of modern finance. And in the 1960s, he asked a question that people thought they already knew an answer to. And the question he asked was, do professional money managers beat the market? In the 1960s, the presumption was they're professional. Of course they beat the market. That's like asking, does a plumber understand plumbing better than somebody who's never looked at a pipe before? So people said, of course. He said, well, if it's of course, let me check and see how well they do relative to the market. He took 128 mutual funds, roughly that number, because there weren't that many mutual funds in the 60s, and he computed the Jensen's alpha for each mutual fund. Remember what the Jensen's alpha is. If it's 0, you're funded as well as expected. If it's positive, you're funded better than the market. If it's negative, you did worse. He actually admitted that he expected to find that most of these 128 funds beat the market, that they had positive Jensen's alphas. To his surprise, 2/3 of the funds had negative Jensen's alphas. And the average Jensen's alpha across all mutual funds was about minus 1.5%. It is one of the most persistent findings in finance. Study after study, and there have been hundreds, have looked at mutual funds, different slices, growth funds, value funds, small funds, big funds, young funds, old funds, small funds, basically all kinds of funds. And every single slice, you get this result kind of show up. Active portfolio managers underperform the market, and the way the measure, and that's why if you talk to portfolio managers, they keep talking about alpha, search of alpha. We want alphas. That's what they're talking about, Jensen's alphas. They want to beat the market. And that's why when you look at hedge funds, you have a very troubling statistic that started to emerge in the last 2 years. Hedge funds in 2007 used to have a Jensen's alpha of about plus 1.5 to 2%. And that was the source of the mistake, that they were actually able to beat the market. They were the smart guys, and that's why everybody wanted to join hedge funds, and there's a lot of money coming in. The average Jensen's alpha across hedge funds last year was minus 1%. They're looking a lot more like traditional mutual funds than super performers. So if you're thinking about joining a hedge fund, it's almost like joining Fidelity now. You're joining a losing business. Hopefully the entity you're joining is the winner in a losing business, but collectively, the Jensen's alpha is negative. So the Jensen's alpha is actually a measure of performance. It's a measure of post-mortem. It's a measure of past performance. It's not a measure of future performance, but it's a useful number to know when you're looking at your company is, did your company over the last 2, 3, 5 years, whatever the period of the regression is, beat the market? So we'll come back and use some actual numbers to back this up, but that is the first stop. Look at the intercept. So let's talk about setting up the regression. There's some mechanical choices I have to make. Let me use Disney to kind of illustrate the choices I had to make. If you look at any textbook, it says the beta comes out of a regression of returns on your stock against returns on a market index, right? Okay, that was easy. So I said, I'm going to try this for Disney. So the first decision I had to make was how far back in time I was going to go to run this regression. Do you see what I mean by that? Disney has been publicly traded since the 1950s. I could go back to 1957 and run a regression for 58 years. That's good, right? More data. But there's a trade-off I have to think about. The further back in time I go, the more I run the risk of finding the beta for a company that doesn't resemble the company I'm looking at right now. 57 years ago, Disney actually produced one movie every 3 or 4 years. In fact, it re-released Snow White every December or whenever it was. It didn't even have Disneyland yet. So it was a single movie company. So it's a very different company than the Disney that you see today, which is in broadcasting and theme parks and movie. It's in different businesses. It's cruise liners. So the trade-off you have to think about is if you go back too far in time, you're getting a different company. If you don't go back far enough, then you might not have enough data. I tend to go back 5 years because, and you're going to see why when I talk about how I slice up the data. But I'm willing to make exceptions. If you ask me to estimate the beta for HP, I might go back weekly for a year. You know what? About a year ago, HP announced that they're going to split up into 2 companies. which means that the beta that I get by looking at a longer period is not going to be reflective of the beta going forward. So how far back to go? Most services use between 2 and 5 years. Bloomberg uses 2 years, Value Line uses 5 years. So essentially, I don't think any service goes beyond 5 years because you run the risk of the company changing too much. So that's the first step. Second, I have to decide once I go back 2 years, 3 years, or 5 years, how I'm going to slice up the data. Let me explain. If I take 5 years of data, I can look at 5 years of annual returns, which means I have how many observations in my regression? 5. And that's not a very good sample size, so keep that in mind. So I could go 5 years of quarterly returns, which will give me 20 observations. 5 years of monthly returns, which will give me 60. 5 years of daily returns, which will give me 1,250. Remember, there are only about 250 trading days a year. With data that we have available now, I can actually go to hourly, minute by minute. So if your only objective is more data, then clearly you want to slice up the data really fine because you get more observations. But here again, there's a trade-off. If you start slicing up the data too fine, you run into trading and liquidity problems. In other words, if your stock doesn't trade and the market trades, then you get a strange-looking beta because if you don't trade, the price doesn't change. In fact, no service that I know of uses anything less than daily, and most services don't even use daily data because even with daily data, you have trouble matching up your transactions when the market transacts. Weekly and monthly tend to be the defaults. Bloomberg's default beta for your company uses weekly returns. There are services that use monthly returns. So and that choice again is going to be colored by the first one. I said that for most companies I use 5 years of data, and with 5 years of data I have no qualms about going with monthly returns. But for HP, if I decide to go back only a year and a half, I have to use weekly returns. I really have no choice. And if you're looking at Shake Shack, anybody doing Shake Shack? No? Just went public, 3 months ago? You have no choice but to use daily returns. It's going to be a completely messy regression. But don't worry, you can still keep going on the regression has to be read with caution, but that's basically the choice that's going to drive. Third factor that now I've decided how far back to go, daily, weekly, monthly. Third thing I have to do is I have to compute returns. What are the two ways you make money on stocks? Assuming you pick the right stock. One is capital gains, and that happens every time the price changes, which is how often? Every minute of every day. So you have capital gains every time it trades. And the other is dividends. And dividends, we have a little bit of a problem, right? Which is, how often do US companies pay dividends? Many pay quarterly, some pay, but most pay quarterly, so once every 3 months. Don't try to be fair. What I mean by that is if you own the stock on which the dividend is paid, it's called the ex-dividend day, you don't have to share with the guys who own the stock for the remaining 2 months and 28 days. So dividends create this discontinuity, which is they get paid out only in certain periods. And in Europe, it actually often is annual dividends. So it'll be 1 month or 1 week or 1 day every year that you're going to see the dividend. And don't worry, it takes care of itself. You're saying, won't that day be a really good day for me? What tends to happen on that day to kind of compensate for the fact that you got the dividend? The price will change as well. So don't worry, it'll take care of itself. So don't try to be fair by smoothing things out. So return should include both price appreciation and dividends because that's how you make money on stocks. And then I come to a final decision. I have to choose an index, right? I mean, you look at the books, it says market index. So I went into Bloomberg and said, give me a market index for the US, and it gave me 125. There are 125 different market indices just in the US. Let me list out a few that you're probably familiar with. When you listen on the news and they talk about the market, for better or worse, what is the market that people tend to talk about still as the market? The Dow. For better or worse, the Dow 30 has this hold on us that in spite of the fact that there's only 30 stocks, we tend to talk about the Dow as the market. If you dig a little deeper, you might have people talking about the S&P 500. What's the criterion for being in the S&P 500? You have to be US based and you have to have one of the 500 largest market caps. So it's, they have to do, they might have a little lag or lead. It's the 500 largest market cap stocks in the US. But that's kind of deceptive because Alibaba is in the S&P 500. Why? Because it's listed in the US. So it is a US index, but it doesn't mean that these companies all make their money in the US. It could be, in fact, 60% of the revenues of the S&P 500 companies come from outside the US. So it's actually a global index, but they're US incorporated for the most part, and US traded. So that's the S&P 500. You have the NYSE Composite, which includes every traded stock on the New York Stock Exchange. And there was a point in time where the natural progression of things was you got listed on the over-the-counter markets, you got larger on the NASDAQ, and when you got large enough, you transitioned into New York Stock Exchange. It wasn't even questioned. Until the tech companies came along and said, why? We don't want to be in the NYSE. We don't want to be in that club. So now you actually have the largest market cap stock in the world, and it's not in the New York Stock Exchange. Apple is a NASDAQ stock. A lot of the big tech stocks have stayed in the NASDAQ. So you can have the NYSE Composite, which is every stock in the New York Stock Exchange. You have the NASDAQ Composite, which is every stock on the NASDAQ. You have the Wilshire 5000, which is 5,000 stocks which are publicly traded. So if you go down the list, there are 125 indices, and you get to pick. See why this is going to be a choice that matters? Because depending on the index you pick, you get a different beta and a different regression. So give me the way in which, you take me through the process by which you decide which index to use in your regression. Let me give you a stock, Microsoft. Okay, so you want to pick an index that actually reflects the stock you pick, right? Why not go the distance and just pick a sector index? Wouldn't that be even better? So, now we're talking. Now, in fact, what are we trying to do? We're trying to estimate a beta for the CAPM, right? Remember in the CAPM what each of us ended up holding? Let's go back to the word of the CAPM. No transactions cost, no private information. What did each of us end up holding? The market portfolio. And what's in the market portfolio? Every single traded asset in the world in proportion to its market value. So here's the tiebreaker. The closer you get to that, the better your market index. Let's go down the list. See the problem with the Dow 30? It's too small, only 30 stocks. What about the NASDAQ? It's a tech index. Nice index, but it's a tech index. The problem with the Russell 2000, it's a small stock in it. In the CAPM, you don't end up holding a portfolio of small stocks. It's in fact the way to think about what the right index to use, and it actually suggests what services are doing right now is not right, because here's what services do right now. In the US, they tend to use the S&P 500, which is the 500 largest market cap companies in the US. And they say it's close enough to the market portfolio because of 500 largest market cap. But in the CAPM, I never mentioned only traded stocks in the US, right? It could be a global portfolio, and it's something I think all services have to start thinking about, is this parochial way in which we estimate betas, where we take a Brazilian stock and run it against a Bovespa, a German stock against a DAX, the French stock against the CAC, is consistent with no model out there. It's consistent with the model where every market's closed and you have no global investors. But for better or worse, in the US, most services end up using the S&P 500, and their defense is it's only 500 companies, but they're market cap weighted, so it's close enough to the market portfolio. So how far back do you go? What return interval? How do you measure returns? What index do you pick? So I'll show you what the choices are made for Disney World. I use 5 years of monthly, which as I said is my default. I use the S&P 500 index, and I'll talk about what would have happened if I'd used a global equity index like the MSCI Capital Index, which is a global equity index. Every month for those 60 months, I computed the return in that month. So let me go through the mechanics. Let's take November through December. The price for Disney at the end of November was $30.22. At the end of December, it was $32.25. So in that month alone, the price went up by $2.03. That's the price appreciation. And during that month, because it happened to be an ex-dividend month, I got a 35-cent dividend, which I don't have to share with the guys who held it in October and November, because that's not what I'm required to do. You add the 35 cents to the $2.03, you get $2.38. You always divide by the price at the start of the month. Don't do messy things like averaging the price, because the way it works as an investor is you buy at the start of the month. You have a price and your returns are based on that price. And I do this for every month. So think in an Excel spreadsheet. I have the prices for every month. I have the dividends every third or sixth or 12th month, depending on when the dividends get paid. And then I get the returns for your stock in every month. So with 60 months of data, I'm going to have 59 months of returns. Do you see why I lose a month? Because I need the price change. So the first month I'm kind of stuck. And I do the same thing for the S&P 500 index. And here I run into a little bit of an issue. I know every day when you wake up and you look at the Wall Street Journal, there's an S&P 500 index there. That's just the price portion of the index, right? There are 500 companies in that index, and they all pay dividends, but they all pay it at different times. So if you actually bought the 500 stocks in the index, you'll be getting little streams of dividends almost every day, depending on which stock is paying. So you can actually, and you can get this off Bloomberg, you can get it off the S&P website. They actually list the dividends you'd have received in the S&P 500 index every month. So every month, here's what I do. I take the change in the index in that month. I add the dividends that you'd have received in that month from the collection of stock, and I get the return on the S&P 500 in that month. And I do this for the index every month for 59 months. I'm almost there, right? I have 59 months of returns on my stock, 59 months of returns on the index. I get ready to run a regression. Then I remember my stat class where I was told never run a regression until you visually scan the data, get a sense of it, which basically takes the form of a scatter plot. If you've never seen a scatter plot, here's what it looks like. You have the S&P 500 index on one axis and you have Disney on the other. You take every month of data and you plot it on the graph. So each of these points, there should be 59 points, reflects a month of data. Then all I have to do is find the best fit line. That's what the regression line is, the best fit line. Now you can try to visually find that best fit line. I'd strongly suggest you don't, because you'll go blind. But in statistics, there's a very simple statistical rule for finding the best fit line, right? What do? We minimize the least squares of the distances. In fact, before we actually had computers and calculators, people used to actually use a ruler to measure each point from the line, square the distances. It sounds like it's outrageous, but that's how you actually used to measure. That's why your sample sizes stayed small. Right? You don't have 2,000 observations if you have to measure each point with. Thank God we have computers that do it for us. But that's what they're doing. They're finding the best fit line. And it did. And in fact, the best fit line is right there. And here's what it looks like as output. The intercept is 0.0071 or 0.71% if you prefer to think in percentage terms. File that away because we're going to use that to decide whether Disney was a good or a bad investment. The slope of the line is 1.25. I got a little carried away and put in 4 decimals, but you really don't. What's this in brackets below the slope? I'm remembering my statistics, which is whenever you run a regression and you get a slope, there is a standard error on that slope, right? So it's truth in advertising. I'm saying, look, I have a slope, but I have to tell you, I'm not that sure about that number because this is a standard error in that slope. And then there's the R squared. Again, I got carried away with the decimals, but it's about 73%. So the intercept is 0.71%, the slope is 1.25 with the standard error of 0.10, and the R squared is roughly 73%. So what I'd like to do is take each of those pieces of output and use it to get a sense of what Disney looked like in the past. So let's start with a post-mortem. This is a regression for 5 years, from 2008 to 2013. If you ask me, was Disney a good investment? Keyword is was. You're not asking me whether it will be a good investment. Was it a good investment between 2008 and 2013? Here's what I'm going to start with. I'm going to start with the intercept. And remember what I have to compare it to? The risk-free rate times 1 minus beta. The regression was run using monthly returns, right? So this is a monthly intercept, so I have to stay consistent. My risk-free rate has to be a monthly risk-free rate. Up till now, whenever we've talked about risk-free, we've stayed with 10-year bond rates. But here we're looking at monthly holding periods, right? 1 month holding periods. So the rate has to be a short-term rate, and it's got to be the rate from that 5-year period. Because you're saying, what would I have made if I'd invested in something risk-free on a monthly basis from 2008 to 2013? The average T-bill rate over the period was about 0.5%. I'm going to cheat and just divide by 12. The reason I'm cheating is usually when you convert an annual rate to a monthly rate, you're supposed to do all this neat compounding stuff, raise to the power of 112. When you have a risk-free rate this low, it doesn't really matter. So your monthly risk-free rate is 0.04%. I multiply that by 1 minus the beta, which I got from the regression. I get minus 0.01%. You're saying, what does that even mean? If Disney had done exactly as predicted during the period of this regression, the intercept should have been minus 0.01%. It actually is plus 0.71%. The difference, 0.72%, is my Jensen's alpha. You know, I'm saying, who cares 0.72%? That's noise. On a monthly basis. If every month you make 0.72%, on an annualized basis, and here I make sure that I follow the rules because 0.7, you take it over time, works out to a 9.02% annualized Jensen's alpha. Let me put some meat behind this number because as it stands, it's just a number. Here's what I'm telling you. During this 5-year period, on a risk-adjusted, market-adjusted basis, Disney made 9.02% more than it should have. And let me give you an abstract, very simple example to bring home this Jensen's alpha. Let's assume the market was up 20% each year. Good period for the market, right? Let's say you're looking at a stock with a beta of 1.25. Let's forget the risk-free rate. It's so close to zero, let's act like it's zero. If you have a market return of 20% and your beta is 1.25, what should I expect your return to be? It should be 20% times 1.25, which is 25%. So if Disney had made exactly 25%, the Jensen's alpha would have been 0%. At least over this period, Disney made 25% plus 9.02%. That's why it's market adjusted and risk adjusted. And the Jensen's alpha tells me that Disney was a good investment over this period. Is it telling me I should go out and buy Disney today? Don't jump from the past to the future. This is not a predictor of what investments are going to be good in the future. It's a post-mortem of the past. And Disney, during this period, generated higher returns than it should have. Yes?
How do we adjust for corporate events to calculate the returns on each company?
You don't. Returns already adjust for corporate events, right? So you have great earnings announcements, you have an acquisition, you have a divestiture. All of that is in that 5-year period.
Stock split or...
Oh, stock split is easy because does everybody know how, if I just look at prices, what happens the month of the stock split? It looks like the price went down, right? So it's just a purely mechanical device. When you do your returns, if there are stock splits, the price has to be adjusted for the number of shares. In Yahoo Finance, for instance, if you go look at past prices, they're split adjusted, which means that you go back in time. And most services, when they report historical data, will split adjust the prices. Because if you had a 2-for-1 stock split, you can't just be looking at prices because it look like a terrible month right there in the middle. So stock splits are a mechanical adjustment. So when you talk about corporate events, I thought you were talking about things companies do. Those are the things that create your Jensen's alpha. Because if collectively you did good things, then your Jensen's alpha should be a positive number. If you did a terrible acquisition like Eastman Kodak did, the way it's going to show up is as a negative Jensen's alpha. In fact, I'd like to put some intuition behind this number. Right? Let's assume that I did for every other stock in the US what I did for Disney. Or at least the S&P 500. I did the Jensen's alpha for every one of the stocks. Starting at A, working all my way through Z. What will the average Jensen's alpha be across all stocks? Or what should it be? It should be 0, right? And you can see why. If I told you that collectively the average Jensen's alpha for stocks is plus 5%, what am I saying? That collectively stocks beat themselves by 5%. And that's actually kind of depressing because when you look at Disney and you see a plus 9%, what has to be true? There's got to be an anti-Disney out there with a minus 9%. You see a Tesla which has a Jensen's alpha of plus 80%. This is a scary thought. There's an anti-Tesla out there with a minus 80%. Life's too short for regrets. So when you do the Jensen's alpha for your stock, if you get a big positive number, you know what your first reaction is going to be, right? I wish I'd bought this stock 2 years ago or 5 years ago. But before you waste too much of your psychic, whatever, energy that you've built up over time on that thought, be glad you didn't invest in the anti-Tesla. and lose 80%. So regret cuts both ways. So you look at the past, just let it go. Okay? But that's all it is. It's a reflection of what happened in the past. So that's the first thing. It has to be close to zero across all stocks because stocks collectively can't beat themselves. See, what if the market went up a lot? Play devil's advocate. Why is the Jensen's alpha not going to be positive for all stocks? Because the market went up a lot. What did I say it was? A market adjusted. So the market goes up a lot, then the expected return is also going to be adjusted. So if you made a 50% return in a period where the market goes up 100%, you're actually going to have a negative Jensen's alpha. So Jensen's alphas, in spite of all the criticism you sometimes hear about the mechanics of how you compute them, are a pretty good starting point on whether your stock was a good or a bad investment during the period of your regression. Second question. In this case, I'm going to play the role of Bob Iger. You're going to be stockholders at Disney. We've computed the Jensen's alpha. It's November of 2013, and I come in a celebratory mood. I say, look, I've done well for you. Look, the Jensen's alpha is 9.02%. I deserve a bonus. See where I'm coming from, right? I mean, you hired me to deliver good returns. I've delivered a positive Jensen's alpha. Should I be entitled to a reward because of a positive Jensen's alpha? And conversely, if the Jensen's alpha is negative, should you think about firing me right off the top? See, the question I'm asking is a positive Jensen's alpha a reflection of great management? Not necessarily, right? Give me a counterexample. When can you have a positive Jensen's alpha and managers can be doing nothing? In other words, if I told you the Jensen's alpha for oil companies was between 2002 and 2011 was this huge positive number. It was. You say, this is good. Oil companies, these companies must have been managed well. Well, why was the Jensen's alpha positive for oil companies between 2002 and 2011? Because the oil price started at 30 and ended up at 110. You could have done nothing, and you'd still have a positive Jensen's alpha. BP actually tried to actually push it. No, we'll get a negative Jensen's alpha no matter what. But that required a particularly perverse set of actions along the way for that to happen. And if I told you that ExxonMobil has a negative Jensen's alpha over the last 2 years, before you freak out, it's got nothing to do with the management. In fact, I don't even think management matters at ExxonMobil. The R squared between ExxonMobil's operating income and oil prices is 93%. I don't even know why they show up. They could just look at the display. What's the oil price today? We're done. Let's go back home. I mean, what are you going to do? You can't change the oil price. In fact, there's a very interesting case working its way through the Texas courts where this guy, I don't remember his first name, Ham, it's not like the ham you eat, but H-A-M-M. He's this oil company CEO who's getting divorced. And his wife is demanding half of his wealth, which was substantial a year ago. And if this case keeps going, he might be worth nothing by the time this is all done because oil prices keep going down. And he is claiming, and this is the peak of the oil prices, that he had very little to do with this company. Usually CEOs claim the success. He's saying, it wasn't me. I'm just a horrible CEO. You can take half of my horrible CEO effect, and that's negative, so half of negative is negative, so you probably owe me money. It's a very, I'll send you the link. It's a very interesting pitch he's making. And you know what? He's probably right. He's not that good a CEO. In fact, he was betting on oil prices going up 6 months ago. He was putting all his money on doubling up, which might either be because he wanted to back up his case in court that he was a really stupid CEO, or because he actually thought oil price would go up in the last 6 months. But a positive Jensen's alpha doesn't mean you're a great manager. Conversely, a negative Jensen's alpha doesn't mean you're a horrible manager. So you're saying, how do I decide that? When you get the Jensen's alpha for your company, take a look at the average Jensen's alpha for the sector. That's what I did for Disney. I got the 9.02%, but I had no way of knowing whether this was an entertainment-wide phenomenon. It was just Disney. The average Jensen's alpha for the rest of the sector was about 1%. Disney was 9.02%. I know it's simplistic, but at least it seems to me that in Disney, management played a significant role in its Jensen's alpha because you can't attribute this to a sector-wide phenomenon. Oh, and my last point was about don't use this as a predictor, right? In fact, if you look at studies that are contrary, if you look at longer time periods, the stocks that do the best in the next 5 years are often the stocks that are the most negative Jensen's alpha in the last 5. Things reverse themselves over time. So be very cautious about using this as an investment template for what stocks to invest in. So any questions about Jensen's alpha? Yes?
In terms of comparing Jensen's alpha to the comparable companies, for Apple, would we use like media companies or tech?
It's actually, I'm glad you raised that question because I think the sectors we have were created about 60 years ago. And we keep squeezing companies into sectors where they really don't belong. So computers were actually devised as a sector 40 years ago, and we squeezed Apple into the computer business. Steve Jobs would have had a conniption if you told him Apple was a computer company. Because his point is, we're not a computer company, we're an entertainment company. So I'm going to have to leave that judgment to you, and it's a judgment. Because I don't know the answer, you don't know the answer, so we're working with almost a new template here. So Apple is it's really mostly smartphone company now. It's 60% iPhone. It's about 25% other stuff and 15% computers. And you might have to do 3 separate businesses to get a Jensen's alpha, and while you're doing that and freaking out, just thank the stars you're not doing GE. Can you imagine you have to do 26 different businesses, get a Jensen's alpha for each one? But it's reality. When you have complex companies, everything becomes more complex. So that's the first stop, Jensen's alpha. Any other questions on Jensen's alpha? So when you get a chance, do the Jensen's alpha for your company, see what it looks like. And I'll give you a shortcut. You don't have to run the entire regression. Next stop, let's look at the slope of the regression. I told you it was the beta. And most banks, if you go in, and I've done this actually, I go to talk to bankers on these re-education programs, which is basically after 5 or 10 years of doing stuff, you tend to forget what you're doing. So they come, as a reminder, they come in and talk. So I said, where do betas come from? And the longer a banker's been around, the more likely it is that you're going to get the following answer. They look at me like I have 2 heads. Where do betas come from? They come from Bloomberg. They come from Barra. Because the reality is when you start working, nobody estimates a beta anymore. You look it up. Who has the time to go estimate a beta? You've got to get the deal done by midnight. So I said, okay, no, that's where betas come from. No, but ultimately betas come from some kind of regression that Bloomberg runs or Barra runs or whoever the service is. But I'm going to play the role of a beta estimation service. You're going to be an analyst looking at Disney. And you're going to call me for some information. You want to be the service, you be the service, I'll be the banker because I get paid more anyway than you do. So I'd like to get that high paycheck. So I'm going to call you and say, I want a beta for Disney. As a point estimate, 1 number. Based on the regression, what's your answer going to be? The slope of the line, 1.25. Then you're going to try very quickly to hang up the phone because you're afraid of my follow-up question. And here's my next question. So that's good, that's a point estimate. But with 67% confidence, which is not a whole lot of confidence because you're going to be wrong 33% of the time, give me a range on that beta. See what I'm asking? I can see the number. The point estimate is 1.25. The standard error is 0.1. What's the significance of 67%? Parameters of regressions are normally distributed, right? In a normal distribution, 67% is plus or minus 1 standard error. So the range on your beta is going to be 1.15 to 1.35, plus or minus the 0.10. That's with 67% confidence. With 95% confidence, it becomes 2 standard errors on each side, 1.05 to 1.45. With 99% confidence, it becomes 3 standard errors. Betas are not facts. Betas are estimates. That's why you can have your company, you can look up the beta on 4 different services. They can all claim to run regressions of your stock against the S&P 500, and because of different time intervals or different time periods, you can end up, and you will end up with 4 different betas for your company. And initially you're going to freak out, say, I got 0.91 from Yahoo Finance, I'm getting 1.03 from Bloomberg, I'm getting 1.15 from Barra. But remember, if you bring in the distribution, the fact that it's not a fact but an estimate, all of those numbers fall within that distribution. And if you think that this is just Disney, I have some really bad news for you. This is a distribution of standard errors for beta estimates for US companies. across all companies, the median standard error for a beta estimate is about 0.25. Think about it. The next time somebody says the beta for Coca-Cola is 1.1, what they're really saying is the beta could be anywhere from 0.6 to 1.61 or 1.6. Basically, that's the range you're looking at. We forget statistics almost immediately after we leave that class, but it's so much of what we do when we look at past data and estimate things is use statistics. But we use it selectively. We use the average as if it's a fact. Just like we did with the equity risk premiums last session. The beta is an estimate. There's a range around that estimate. Which brings me to the third and final piece of output from the regression. I get that R squared. Remind me again what that tells me. 73% of the risk in Disney comes from the market. 27% is firm specific. So if I put all my money in Disney, what am I going to be exposed to? All of this risk. If I diversify and I hold Disney as part of a diversified portfolio, which part of this risk is going to disappear? The 73 or the 27? The 27% is going to go away. Which actually is not a bad number because the median R squared for US companies is closer to 30 or 35%. So if you're going to put all your money in one stock, you can probably get away with it in the case of Disney. You're not going to get away with it if you put it all in Twitter or Shake Shack, because those are companies which will have much lower R squareds. In fact, I want to kind of tether that concept by making you choose. The beta that I got is 1.25, right? R squared is 73%. Let's say I run a regression for Amgen. I get the same beta, but I get an R squared of only 25%. You be a diversified portfolio manager, and it's key that you realize what you are. You're a diversified portfolio manager. I come to you with these two stocks. They have the same beta, but different R squareds. Would you put your money in the lower R squared stock, the higher R squared stock, or be indifferent between the two? Remember, you're a diversified portfolio manager, right? Remember what happens to everything that's not R squared if you're diversified. What happens? It disappears in your portfolio. So what are you left with? Just the market risk. And in that perspective, it looks like 75% is higher than 25%. But remember, that's as a percentage of total risk. The units of risk you're exposed to is captured by the beta. And what am I telling you about these two stocks? They have exactly the same beta. You say, how can that be? How can you have the same beta with these wildly divergent R squared? Let me give you a completely nonsense analogy. You're all familiar with Shaquille O'Neal, right? So, when Shaq was at his peak, he probably weighed, 330 pounds? What if I told you? Now, I on a good day weigh about 125 pounds. Shaq at his peak had very little body fat. Now, of course, he's all body fat, but that's what happens when you let it go, right? So let's assume I told you that 5% of Shaq's weight is body fat, and 10% of my weight is body fat. So I have more body fat on a percentage basis, right? But if you look at it in terms of pounds, 5% of 300 pounds or 350 pounds or whatever he weighed is still going to be higher than 10% of 125 pounds. And that's the way to think about R squared. R squared tells you the proportion of your total risk that comes from the market. And if you have very little total risk, you can have this huge R squared and end up with low market risk in units. That's what the beta measures. Or you can be a biotechnology company with an astronomically high total risk, but only 20% of that risk might be market risk, but that 20% can still be a very high number. So separate betas and R squared. They measure the same thing, but they measure them in different ways. So intercept, slope, R squared. Now, until about 1999, I used to have people do these regressions on their own. So basically, if this was the point of the class, I'd say, I've run this regression for Disney by collecting 59 or 60 months of prices, 60 months for the index. You go and do it now. And that would take about a week of torture because it's not difficult, but it's tedious. You have to collect the data, you have to put it into months, you have to make sure you don't get off by a month because then strange things happen. But it's not difficult to do. You'd end up with a regression. And about maybe 12, 11 years ago, we got our first Bloomberg terminal installed at Stern. And if you haven't found it yet, find it soon, right? Because the way they charge us money for it, they might take it away any day because they think they're doing us a favor by charging us only 25,000 or whatever it is. It's a huge amount of money. And the nice thing about having access to a Bloomberg terminal is this process is short-circuited. I can get the beta for Disney, for instance. Remember that regression I showed you? I could have run the same regression in about a minute and a half if I'd got to a Bloomberg terminal, found Disney, typed the word beta. Initially, the beta I get is a Bloomberg beta, which is 2 years a weekly. But let's say I reset all the things to match my Excel regression. 5 years, 2008 to 2013. Monthly, because I use monthly. Remember I said Bloomberg's default is 2 years a weekly. And I reran the regression, Disney against the S&P 500. Exactly the same period, exactly the same stock, exactly the same index, with exactly the same return interval. We should get exactly the same numbers, right? What I'm going to do is I'm going to take you through the Bloomberg output page, and I'd like you to stay on page, or go back to page, I'm sorry, where I had the regression. Where the heck was that page? Yeah, which was page 125. You go back to page 125, and let's see if we get the same numbers. So ready, you're on 125. You have my Excel regression where I collected the data myself and ran the regression. I really, really want these numbers to match up, right? Because otherwise I have to ask you guys to do all the raw data stuff. So hope and pray that the numbers do match up. Okay? So let's start at the top. Raw beta. You think raw as opposed to cooked? I mean, we'll come back to that. We'll, why. That's your regression beta. According to Bloomberg, it's 1.247. What is my beta? 1.252. We're within shouting distance. So far, so good. Okay. I'll come back to the adjusted beta. Bloomberg has this nasty habit of naming things that they shouldn't be named. It calls the intercept alpha because that's the it's not the Jensen's alpha. That is actually the intercept. According to Bloomberg, the intercept is 0.60% or 0.599%. My intercept was 0.71%. So we're off. We'll come back to that because this is something that will consistently happen. And we'll talk about why it's happening. Okay. The R squared of the regression, according to Bloomberg, is 73%. I'm off by the third decimal point, but so the beta is roughly the same. The R squared is roughly the same. The intercept is different. And this used to drive me crazy when I first started using Bloomberg. Why am I getting a different intercept even though we're using the same data? And here's the reason. When I ran my regression, when I computed returns for Disney, what did I do? I took the change in the price, and then I checked to see if there was a dividend, and if there was a dividend, I added it on. When I did the returns for the market, I took the change in the index, and then I took the dividends in that month and added it on. Bloomberg's regressions are price regressions. Why? Because it's easier. It's not like a guy is sitting there running these regressions. The computer running the regressions. It's so much easier to feed price data into the computer, say run the regressions. So it saves them an incredible amount of time not having to bring dividends in. And their defense is, most people use this regression to look up what number? The beta. The beta is pretty close, so why are you making such a big deal out of it? Most of the time I don't. But I'll tell you when it's going to make a difference. If you invest in a master limited partnership or a real estate investment trust, what do they share in common? Big dividends get paid out. And you don't count dividends as part of your returns, then what the heck are you counting as returns? That's how I make my money. So stocks that pay big dividends, the Bloomberg beta is going to be off badly because you're missing the big part of the returns. You see, what's this adjusted beta thing? Why are we even talking? But they've adjusted the beta for us. Let me give you the equation they used to adjust the beta, and we'll talk about whether it's useful or not. I suggested that you print off the beta page for your company. I don't know how many of you did, but if you did print off the beta page, take a look at your adjusted beta. I know most of you haven't. Right? And use the algorithm that I'm going to give you they use for Disney and see if it works for you. Here's what they did for Disney. They took 2/3 times the raw beta plus 1/3 times 1. So let's see that. So let's see what they're doing. 2/3 times 1.247 is about 0.8 something, 0.834, plus 1/3 times 1 is 0.33. There's your adjusted beta. 2/3 times the raw beta plus 1/3 times 1. So what the heck are they doing? If your raw beta is 1.8, your adjusted beta is going to become 1.53. Your raw beta is 1.5. Your adjusted beta is going to become 1.33. 1.2 is going to become 1.13. 0.6 is going to become 0.73. So what are they doing? They're pushing betas towards 1. What's so magical about 1? It's the average beta for the market. They're trying to help you. They're saying, you know what, your company will probably get bigger over time. It'll probably get more diversified over time. So therefore, the beta should move towards 1. We'll move to 1 for you. To which your response is, please stop helping. Because this 2/3 and 1/3 that I just described for Disney is what they use for all 41,000 companies that they get the adjusted beta for. Every single company, it's 2/3 times the raw beta plus 1/3 times 1. They must be magic weights to work for every company in the face of the earth in all these different markets. Now I could ask you where the weights come from, but it wouldn't be fair because I didn't know, so I called Bloomberg, not the mayor, but the company. Maybe I should have called the mayor and said, what's his, maybe he'd have given me a better answer. And they put me in touch with the beta calculation guy at Bloomberg. There's a guy at Bloomberg whose life it is to maintain this page. Imagine how exciting his life must be. He goes to a cocktail party and says, I'm the beta guy at Bloomberg. Dozens of people gather around for anecdotes. Not. He picks up the phone. He's pathetically grateful to get a call from the outside world. I don't know what they do to the guy. Maybe they keep him locked up in a basement room, feed him through a hole in the wall. He says, I'm so glad you called. I have all day to answer your questions. I have all day to ask him the questions. I was afraid if I hung up the phone too soon, he might do something rash. So after about what I thought was polite conversation for about 4 minutes, and after that I ran out of polite, I hit him with a question. Why 2/3 and 1/3? 2 minutes of silence. I can hear papers being rustled, terminals being turned off and on. Finally comes back on. He says, I don't know. It was here when I got here. I said, what do you mean? He said, I was hired 2 years ago. It was already here. Don't blame me. I said, I'm not blaming you. I want to know where those numbers come from. I said, I don't know. Here when I got here. I just finished my 10th book last year. I have the title for my 11th book picked out. I haven't written a word of it, but the title is the most critical part anyway. It's going to be called Here When I Got Here. Because you know how often that is going to be the answer to questions you ask about numbers that float around your workplace every moment of every... Why are we doing that? Where did that number come from? I don't know. It was here when I got here. When did you get here? 1978? You've never stopped? No, I just do my job. I move on. It's amazing how much of corporate finance and valuation we've outsourced. You get your betas from Barra, you get your equity risk premium from Duff and Phelps, you get your risk-free rate from the Federal Reserve side, you get your cash flows from the managers, at which point I'm asking, what the heck do you do? I mean, all these numbers feed into your model. I call these robo models. Basically, I mean, you don't need a person, everything feeds in. Okay? Or in a bad mood, I call them kabuki models. They look like models. You've seen kabuki dances. It looks like as if it's very, but everything is planned. Okay? So the adjusted beta tells you absolutely nothing. It tells you which direction one is. And if any of you have serious doubts about where to go, if you're at 1.8, so how the heck do I get to 1? You go 1.6, 1.4, 1.21, you're there. You don't need some guy holding your hand saying, let me give you a number closer to 1 in case you're confused. That's all they're doing. So when you look at the beta page, take a pen, draw a line right through the adjusted beta, color it fully so you can't even see what it is. It is a completely useless number. But the nice thing is you don't have to run the regression beta. I'm willing to accept that dividend problem and let you use this page as your beta page. Now before we lose sight of what we're trying to do, I'm trying to estimate a hurdle rate for Disney, right? We've talked about a risk-free rate. We had an equity risk premium for Disney. And if I trust this regression, the beta for Disney is 1.25. Let me bring those all together in November of 2013. Here's what the numbers look like. The beta is 1.25 to the extent that I trust the regression. The risk-free rate was 2.75%. That was the 10-year T-bond rate. And the risk premium, remember how I calculated as a weighted average? Disney gets 82% of its revenues from the US, 18% from elsewhere, is 5.76%. 2.75% plus beta times risk premium gives me an expected return of 9.95%. Now we do this ad nauseum in finance classes, risk-free rate plus beta times risk premium. And it's very easy to lose connection to what exactly this number means. So let me again try to put some flesh on this number. Let's say this is November of 2013 and you're potential investors in Disney. I'm going to try to describe this 9.95% in words and you tell me whether this is a fair description. So So I've done the mechanics of the 9.95%. So here's the first description. 9.95% is the return you can expect to make on Disney in the long term if the stock is correctly priced and the CAPM is the right model for risk. How many qualifiers have I added in that statement? Let's see. Expect to, so no guarantees. Long term, so don't come to me next year. Correctly priced, if it's mispriced, all bets are off. And the cap. 4 qualifiers in one sentence. I'm an incredibly lazy person. If I put in 4 qualifiers, it's because I want to make the statement true. So technically, that is one way to describe the 9.95%. And if you lived in a world where you thought markets were efficient, that's it, you're done. So how do you earn a higher return then? You go buy a higher beta stock. There is no easy way. I teach valuation, and this definition doesn't appeal to me, because in this definition there's no point doing valuation. You just pick the stocks with the highest betas, you get a higher expected return. So I'll give you a second description which I find more appealing. 9.95% of the return I need to make on Disney. Suddenly I've become a very needy person to break even on my investment. You see, what do you need to make 9.95%? The risk-free rate is only 2.75. Why don't I settle for 2.75%? Because it's not risk-free. If I wanted to make something risk-free, I would invest in a T-bond. 9.95% of the return I need to make. And if I don't make that, then I've actually underperformed on this stock. And the reason I like this is I think the whole process of equity research, of doing investment analysis, is for you to make your own judgment on what you think your return will be investing in Disney. So you collect information on the movies they're producing, the broadcasting shows, how Frozen will show up. And based on your assessment, let's say you believe, and this is your belief based on your research in Disney, that you can make 12.5% a year. Now do you see how the 9.95% kicks in? 9.95% is what you need to make. You think you can make 12.5%. That would make Disney, if you are an equity research analyst, a buy or a sell. That's my definition of a buy, because you're making more than you need to. So to me, that's why I've never understood equity research analysts who are proud about the fact that they don't get this CAPM stuff. Fine. They say, my job is picking stocks. I say, how do you pick stocks without a benchmark? Have you seen an equity research report? Usually there's a price today, there's a target price in 5 years. I've never understood what I'm supposed to do with that. So I'm glad the target price is higher than today's price. That's kind of a minimal standard. But for me to decide if going from 40 to 60 is good enough, I need to figure out, based on the risk of the stock, what I need to make. So don't tell me Tesla will go from 200 to 250 over the next 3 years. It's not enough. It's not because I'm greedy, but because if I don't build up some fat on the way up on these stocks, I'll have nothing to burn off on the way down. And guess what? With risky stocks, there will be journeys down. And that's why you need that upside. It's danger plus opportunity. And the 9.95% tries to capture it. So that 9.95% becomes the return you as Disney stockholders need to make on Disney to break even, right? Now if I'm a CFO of Disney, you see what this makes it to me? You're my stockholders, what do you need to make? 9.95%. We talk about the cost of equity as an abstraction. The cost of equity is what you guys need to make on this investment to break even. This 9.95% now becomes my cost of equity. And my job then in Disney is to deliver a return on equity in my projects that is higher than that 9.95%, at least on average. We'll talk about differences across investments. But when we talk about the cost of equity being this number, we're already making an assumption about what drives you as manager of a company. Let me explain. About a decade ago, I remember a conversation I had with the CFO of a very large Asian company. So I was sitting across the table from him. He said, what's my cost of equity? I said, maybe 11, 12%. He said, it's not. I said, if you know what it is already, why the heck are you asking me? He said, it's 1%. You know what he was calling his cost of equity? The dividends he had to pay. He said, that's all I have to pay. What's this? So explain to him intuitively what the difference between the 1%. How do I get from the 1 to the 12%? What's the extra 11% in this model for? It's expected price appreciation. People don't buy stocks to just get the dividend. If they wanted that, they'd buy a bond. I said, your investors are expecting price appreciation. And then he asked me a question that floored me. He said, what if I don't deliver that price appreciation? Do you see where he was going? If I borrow money and have an 8% interest rate and I don't pay it, I get into trouble. I default. If my investors buy my stock expecting to make 12% and I deliver only 1%, what's going to happen? So humor him or me now. What's going to happen? Your stockholders are going to get pissed off. They're going to sell your stock price is going to go down. He said, I don't care. I said, what if you have to issue stock? He said, we're a mature company. We don't plan to raise equity in the near future or the far future. So I had to hit him with the next point, which is if your stockholders get pissed off enough, what could they do? They might try to fire you. He started laughing. He said, do you see the last name on mine? Do you see the last name on the company? You see their match? He said, basically what he was saying is, hey, they can't do a thing to me. I control this process. I have all the voting shares. Now do you see why we spend so much time on corporate governance? If you're in a system with really, really weak corporate governance, you're going to attach a really low cost of equity because your reaction is, what the heck are they going to do to me? Japanese companies did this in the 1980s. And what did they do as a consequence? They thought their equity cost them only 1%. So when they took a project that made 2%, they said, this is good. And they're now saddled with investments they took that they had no business taking because they didn't care. So when we use this as a cost of equity, we're already embedding in it our assumption that corporate governance is that you are managing this company for the stockholders. Because if you're not, you can pay lip service to this cost of equity, but you're going to be taking projects like crazy that deliver well below the cost of equity because you are not afraid. So when you get a chance, take that Bloomberg beta page and do it while it's fresh. In fact, this week's In Practice webcast, I take you through the page item by item. So if you get a chance, watch the webcast. I'll put it up on Friday, of going through a Bloomberg page and breaking it down into what's the Jensen. So you're going to be doing for your company what I did for Disney. And at the end of the process, you should be able to tell me whether your stock was a good or a bad investment during the period of your regression, what your beta is, what the standard error in the beta is, with the range in the beta, how much of the risk in your stock comes from the market by looking at the R squared. None of this is precise. They're all estimates, they're all noisy, but I think of it as the equivalent of when you get a new doctor, they run you this whole set of tests on you, what's your blood pressure, to run. This is similar to that. You're getting acquainted with your company. This is a great way to get acquainted by running this regression. And if you can, and I know you're a little behind on this, see this last thing where you get a cost of equity? To do that, you have to have picked a company first. All of this is kind of irrelevant. Second, based on the company, you have to pick a currency and come up with a risk-free rate. So all the to-do items on your to-do list will kind of come together in this critical mass. But if you can pull this all together, you should have a cost of equity by tomorrow evening if you wanted to for your company, at least as a preliminary estimate. The beta still troubles me because it comes from a regression. We know strange things can happen. We'll come back and talk about it. But the process at least will be laid down. Now let's kind of fill in the last piece here. The expected return on a stock is a risk-free rate plus beta times risk premium, right? So if you have a high beta, you're going to have a high cost of equity. I'm going to play a little game. Let's assume I'm the CFO of a company, a technology company, and you're my banker. So I come to you and say, well, I need some advice on my cost of equity. So you plug in the numbers, risk-free rate, and you come up with this really high beta. Why? Because I'm a risky company, beta of 3, and you give me a cost of equity of 20%. You give me that number. As a CFO, am I happy to see this high number, or oh, this is not good for me? The 20% means I've got to beat the 20%, right? So I start complaining. I said, and this is my basic question, can I, you show me why it's high. It's because my beta is high, right? So I ask you a question, can I bring my beta down? What is it that I can do? Are there things I can do as a company to reduce my beta? Any ideas? What can I do? First is I can go into safer business, right? Each of these choices, not necessarily good choices, but if I really wanted to bring my beta down, I could go into safer businesses. In fact, in software, the way this is starting to show up is if any of you have Adobe products, you know that you can no longer buy Adobe Photoshop or Adobe Dreamweaver, you buy an annual subscription. And for software companies, this is a way of smoothing out there, because it used to be that you get those spikes every time you did an upgrade. So you might be able to change your business to make it safer. So that's what. Any other things I could do? Yes? Now we're talking about game playing. If I can make it move less, I can make it move less in one of two ways. I can do really stupid things every month, in which case you know what's going to happen. My price will keep dropping no matter what the market does. Or I can do really smart things every month. It's so easy, so much easier doing really stupid things because that template is out there for us. But I could try to do that, but that's going to be tough to do because remember, my stock prices are driven by the business I'm in. Much of what I'm doing is actually firm specific. It's very difficult to alter that underlying relationship. I'm sorry? Well, you're talking about changing the index? No, but remember the sequencing. You don't get to see what the S&P 500 did before you act, right? It's contemporaneous. You're going to be making decisions through January. The market's moving. It's not like I tell you what the market will do next month, and then you say, okay, what am I going to do? You have no idea. In fact, you're taking actions while the market is moving. You can try, but it's going to be really, really difficult to do. Any ideas? Any other ideas? That's actually extension. If I go to say for businesses, I'm kind of spending. What if I have debt? Can I?
Just focus on making the current business more mature, more customers, more.
But in the sense that again, I can control a few aspects of it. But if I am Uber, it's tough to make my business mature because I am a small company in a business that's kind of exploding around me. So the degree that I can control that, I might be able to kind of slow the process down, set up for less growth, go to safer businesses. If I have debt, can I do something about it?
If you have more debt, then you just have to pay the bond.
Pay down the debt, right? Because if you reduce your debt, your equity. I'm not saying any of this is sensible, but you could. The reason I'm a little wary about this focusing on the market and changing the correlation is it's easy to play games. In fact, here's a very simple way to change your beta. Give me a Bloomberg terminal, give me 30 minutes and tell me what beta you want. And I promise you, I will deliver a beta that you want because all I need to do is change the index, change the starting point, ending point. That's game playing. And analysts do it all the time. In fact, if you do that to lower your beta, and again, I'm going to give you a completely strange analogy, is every morning when I wake up, I usually wake up around 5:30, I get on the treadmill. I have 35 minutes and I'm off. That's it, I'm done. And my dream has always been to burn 1,000 calories in 35 minutes. It's really, really tough to do when you're 125 pounds. Until one day I found the secret. First thing you get on the treadmill, what does it ask you? How much does you weigh? Enter 500 pounds. The treadmill's too stupid. It should kick you off saying, get off me, you pig. But if you put in 500 pounds, you can walk and the calories roll off like, you can go through 1,000 calories without doing a thing. But the reality is, at the end of 35 minutes, I've burned through the 500 calories I always burn through. What I'm trying to say is, you can change the beta on a regression page, but you're not changing your business risk by doing this. And none of this might make sense. In fact, if you're the CFO of a company and you're a risky company, here's my advice to you. Take the hurdle rate. It's a high number. What's your job? Deliver projects that earn returns higher than that high number. Your job is not to lower your hurdle rate. It's to go find good investments. And I asked them a simple question. Would you rather be Google, which has a high hurdle rate and delivers a higher return, or Cornet, which has a really low hurdle rate and delivers a low rate of return? And of course, some CFOs said, I'd like to have Cornet's cost of equity and Google's return on equity, at which point I've got to whip out the Chinese definition of risk and say danger plus opportunity. But this is not about trying to make your company safer. It's about delivering projects that earn a return higher than that hurdle rate. So I'll stop there because when we get back, I'm going to take you through the beta pages for the rest of my companies. It will help if you've looked at the beta page for your company and started working through the numbers at least. Yes.
I'm having trouble with the wording regarding the expected return rate that was 9.75 and you said that was the break even. How is that? Because let's say I put in $100 on stock and I get 109.75, I actually make $9 profit. So how does that?
Because it's not guaranteed. That's what you need to make if the market is up 8% during the course of the year. because there'll be good years and bad years. It's not like a bond. It's not like I'm telling you make 9.5. That's your expected return. You could make 18, you could make 3.
So it's perception, basically.
It's expectation. It's not a perception. It's an expectation because you invest based on the future. It's an expectation of what you can make.
So only if you make something higher than an expectation, you actually make a profit.
Well, if you make 9.5%, you're not losing. You're making a fair. So when you put your money in an index fund, you're saying, look, I don't want to beat the market. I just want to match the market.
Right.
So if your end game is, look, I want to invest to make what the market is making, you're going to settle for that expected return. So that's why you invest in index funds. I can't pick stocks. I'm just going to invest my money where the expected return is high enough. So there's nothing wrong with that. You'll make money, but you'll make as much money as the market is making.
But it's not breaking even. It's actually making money.
You'll be breaking even relative to the market, right? If you want to beat the market, which means you want to do better than what somebody investing in an index fund does, you can't just deliver the 9.5%, you got to deliver more. You can try and find out after 3 years you're not doing it, in which case go back to an index fund. So because you're not losing money on an index fund, you're getting a return that is a fair return given the risk you took on, but you're saying, I want more than that. Right? So there's an element of greed. You're trying to beat the market, but we all do. That's why we all look at Warren Buffett as our, not Jack Bogle, who invented index funds. So if you get that expected return, you're breaking even. Doesn't mean you're losing money. You're earning a fair rate of return given your risk.
Well, it's only for rate that it breaks even with the market.
Yeah.
Got it.
Given the risk you took on.
Okay, thanks.
Yep.
Which index you pay for your company's paid?
You want the broadest index for every company. It's nothing to do with your company, right? It's got to do with the CAPM, where everybody holds a market portfolio.
Yeah.
So you don't pick an index that matches your company. You pick an index that reflects what you think marginal investors are investing in. Now, if you believe that investors are still mostly local, that they invest mostly in local stocks, then you might pick a local index. You pick the S&P 500 or some broader U.S. index because you're saying it's true that we can globalize, but most investors are not globalized, so I'm going to measure risk against a U.S. index. But as investors get more global, and they start at the margin looking at that global portfolio, every company's beta will have to get estimated against a global portfolio. It's got nothing to do with your company anymore. It's got to do with how do investors perceive your company. If they're investing in a global portfolio, then you should be measuring risk against a global portfolio.
So that's, you did that for Indian hotels that did it, switched to Sensex.
That assumes that you have investors in India primarily in Indian stocks, and in India you might actually be on track doing that because Indian investors are not allowed to invest outside.
Exactly.
So there the argument is I want to stay with the Sensex. But I'll tell you what will break it down is India also has foreign institutional investors who come in, like the Fidelities and State Street. When they look at Indian hotels, they measure risk against a global portfolio. And if they see less risk, guess what they're going to do? They're going to push the price of Indian hotels up. They're going to push local investors out. They will become the marginal investors.
Yeah.
In which case, if you're running Indian hotels, you now have to keep the foreign institutional investors happy, not the domestic institutional investors. The way you measure risk then is against a global portfolio.
Okay.
So I would actually estimate,
Back to the marginal estimate.
because the marginal investors now become a global investor. So that's really what it goes back to. If your marginal investor is a global investor, then a global index should be used. If your marginal investor is a domestic investor who invests only in domestic stocks, you stay with the Sensex. Indian hotels, depending on, it will vary by month to month, depending on how much money is coming in. This month, I would say run both regressions. On a Bloomberg, you can just change the index.
Well, no, so I did that.
Yeah. They're very different.
They're very
And that's actually that'll actually feed into why we have these big inflows and outflows from foreign institutional investors, is because there's a big difference, and to the extent that there's noise, you got to factor that in. You're going to see foreign institutional investors essentially dominating the trading on a stock if they think domestic investors are charging too high a return, or pulling away from the stock if they think domestic investors are settling for too low a return. It can cut both ways.
So at that point, you make a choice and argue for one or the other.
No, if you're